I'm watching silver in particular, COMEX silver. Also, we're seeing now that silver is obviously tight in London, but it's also becoming tight in Shanghai. This is a global phenomena. This is not, oh, there's plenty of silver, but it's in the wrong place. No, there's not plenty of silver. And what I'm watching as far as COMEX is concerned, November is strictly a non-delivery month. And the amount of contracts being added on a daily basis for November delivery is astounding. December, on the other hand, is a big delivery month. And I question, can they deliver 60, 70, 100 million ounces for the month of December?
In this powerful breakdown, market analyst Bill Holter delivers a critical warning about what's happening behind the scenes in the global silver market. According to the latest data he's tracking, silver tightness is no longer limited to one region. Both London and Shanghai are now showing signs of severe supply strain. This isn't a case of silver simply being in the wrong place. It's a sign that there is not enough physical silver available worldwide to meet mounting demand. Holter highlights an alarming trend on COMEX. Despite November being a non-delivery month, an unusually large number of new contracts are being added daily, raising questions about available inventory. The real stress test arrives in December, historically one of the biggest delivery months of the year. With potential obligations of 60 to 100 million ounces, the key question becomes whether the exchange can meet those demands without exposing deeper structural shortages. This tightening across every major hub suggests the silver market may be approaching a pivotal moment, one that could reshape prices and supply dynamics globally. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now, listen to the interview.
There's concern. If gold were to go, if gold doesn't deliver, the system dies anyway. But if gold doesn't deliver, it's not a direct effect on production, if you will. Silver is used in so many different applications, whether it be industrial, technological, medicinal. I just did an interview and was talking about every time they shoot a Tomahawk missile, there goes a monster box. You can't make a Tomahawk missile without roughly 500 ounces of silver. So silver will have profound ramifications to the real world, to the real economy. Now, that said, if silver goes failure to deliver or gold goes failure to deliver, you're stuck in the casino because the casino will close. And when the casino closes, and we've talked about this, for the last, year and a half, maybe even 2 years, we've talked about the great taking. Once the casino closes and banks and brokers and insurance companies start going belly up, they're going to take your capital with them. If you're looking to sell junk silver, you're looking at $3.50, $4 under spot. And if you're looking to buy junk silver, you can buy it at spot, maybe 50 cents over spot. It's the cheapest form that you could buy right now. So if you're buying silver, you definitely want to buy junk silver. It's the cheapest and it's the best. And if you're worried because the bid is below spot, and it's well below spot, pretty much everything else is very close to spot or even eagles or above spot, understand what has happened. We finally got back to this $50 level, and we stayed here. We've been here for, call it, a month, but we're approaching it. And literally, I'm not going to say the only form or the only way to buy silver in the late 1970s, early 1980s was junk, but that was by far and away the primary form of silver to buy. So what you've seen over the last few months is that many of these people who have held on for 40 plus years have turned seller. And the dealers and the wholesalers got overwhelmed with the selling. So what did they do? They lowered the price. And if they're, call it $4 under spot, that's 8% below spot. And what they're doing is they're sending those coins into refiners to melt them down. And they pick up that 8% is what they're doing. Now, that said, this is a short-term event because the supply is already The supply of junk being sold is already starting to dry up. And when it does dry up and prices start to normalize, guess what? There's way less junk available that still exists because it's been melted down. And I'm gonna say right here that I think when all is said and done, junk silver is going to become the most expensive form of silver in the United States, even priced higher than eagles. And I say this because I believe the supply is being destroyed on a daily basis. The paper markets were the tail on the dog, but the tail constantly wagged the dog because they would overwhelm the physical markets with paper. The problem now is they've done it for so long and to such a grand extent that now there's a question whether these paper contracts are going to be able to deliver. And the answer I think you're going to find in the next month to 3 months, we're going to find out that no, the paper markets are not a substitute for real physical because they have to deliver real physical that does not exist to be delivered.
The global silver market is entering a critical phase that could have far-reaching effects on both investors and industry. With silver prices holding around the $50 mark, the dynamics between physical and paper markets are becoming increasingly apparent. Unlike gold, silver has broad industrial, technological, and even military applications, from electronics to missiles, making its availability vital to the real economy. Currently, junk silver is trading at prices significantly below spot, offering one of the cheapest and most accessible ways for investors to acquire physical silver. Dealers are overwhelmed with long-term holders selling older coins, which are often sent to refiners and melted down, gradually reducing the available supply. As this supply tightens, junk silver may eventually become the most expensive form of silver in the United States, potentially even surpassing American eagles in value. The underlying concern is whether paper silver markets can truly deliver physical metal when needed. With large-scale paper contracts dominating trading, a delivery failure could expose the fragility of the system. As physical scarcity continues to grow and paper contracts reach their limits, the market may experience dramatic moves in the coming months. For those watching closely, this is a crucial moment to understand the difference between paper and physical silver and why scarcity in tangible assets is becoming impossible to ignore. The next 1 to 3 months could provide a clear signal about the market's trajectory and the real value of owning physical silver. Let's get into the interview.
Then conveniently along came COVID, and two things happened. The real economy worldwide was definitely stunted or shut down, whatever you want to call it. There was less demand for credit because of COVID, and it allowed central banks all over the world to flood the markets with liquidity. Problem solved. Not solved, but the can was kicked down the road. Here we are again. We're nowhere near where we were in October of 2019, but the overnight rates are starting to move higher again. It's a concern and should be watched. Again, everything, whether it be the real economy, production, consumption, transit, and also the financial world, the financial economy, everything runs on credit. If credit gets disrupted or credit ceases anywhere, it'll be a shock that it'll shut the whole system down. We have interest rates still at basically generational lows. I mean, we're not where we were 3 or 4 years ago. We're not at 0% rates, but rates are extremely low. There's no risk premium in interest rates at all. So brokers and banks, they understand that the likelihood long-term, 5 years, 10 years, longer than that, the likelihood is that rates are going to go higher, not lower. And they also understand that there's going to have to be another mass printing, whether they call it QE or not, it doesn't matter. But there's going to be another global mass printing. And the problem with that is that debases the currencies, and that lowers the value of the unbacked currencies. If the values are lower, then you got to give more of dollars or euros or yen or whatever for that same ounce of gold or the same ounce of silver. So I think they're looking at it pragmatically and saying, yeah, the day of buying and holding bonds is over, and that's why they're recommending half of that bond position be liquidated and put into gold. The only problem with that is if everybody did that, you'd have gold at probably, who knows, $2 million an ounce. Just pick a number, but it's going to be super, super high.
Financial strategist Bill Holter delivers insight into the current state of global credit markets and their implications for gold and silver. According to Holter, the COVID-19 pandemic created a unique environment. Worldwide economic activity slowed, reducing demand for credit while central banks flooded markets with liquidity. While this temporarily eased financial stress, the underlying issues were merely postponed. Today, overnight interest rates are rising from generational lows, signaling that brokers and banks anticipate higher long-term rates. The low-risk premium in current rates, combined with massive global debt, makes holding unbacked currencies increasingly precarious. As currencies are devalued through ongoing debt issuance and future rounds of quantitative easing, the purchasing power of dollars, euros, and yen diminishes, directly boosting the value of tangible assets like gold and silver. Holter notes that institutional recommendations to shift portions of bond holdings into gold reflect this reality. A large-scale migration could push gold to unprecedented levels, illustrating the market's sensitivity to currency debasement and credit dynamics. For investors, the key takeaway is clear. Tangible assets are becoming essential hedges in a world of rising rates, mounting debt, and currency risk. Understanding these forces is crucial for positioning portfolios before the next major financial shift. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.